All right, all right. We are back in beautiful Belmar, New Jersey at the next episode of Grit Won't Quit. I have a very special guest on. We have Stacey Ellison on today. Stacey, how are you?
I'm good. How are you doing, Tom?
Great. Thank you for coming on.
Oh, thank you for having me.
Stacey and I met through the networking group 3C. Great organization. Shout out to Jeremy and everybody in 3C. But one of the first people I met at the first breakfast at Jeremy's old office was Stacey. So I'm glad that you got to come on the podcast. And you do something unique. So like it was kind of a good fit because unfortunately it happens, but at least there's somebody like yourself to make it a little bit easier.
I hope I get to do that for people.
So you do divorce mortgage work,
Yes.
primarily, or as a subset of your regular
Yes.
business. But
Yes.
it's a specialty that there's not a lot of people in New Jersey that do that.
True.
So let's dig into how you how long have you been doing mortgages?
Oh, God, I've been in the mortgage industry for about 30 years.
I can't even believe it. When you started 7 years old. But all right, so you've been doing mortgages for a long time, and everything's going well. And then, what was that trigger moment with the divorces?
So I ended up having, within like a 6-month period, I had several clients come to me who were newly divorced. And they're like, hey, I just got divorced. I need to refinance and take my ex-spouse off the home. Or, hey, I need to buy a new home. I was like, okay, great. I'd love to help you. And in each situation, there was something about the settlement agreement that conflicted with the mortgage guidelines. And we ran into obstacles. So either they didn't have enough time, they couldn't document the alimony or child support for long enough, or it wasn't going to last long enough and we weren't able to use it, or they just started a second job and they needed that income, but the guidelines didn't allow. You have to have a certain amount of time on a second job. And it got really frustrating, not only for them, but for me as well, because I don't like telling people I can't help them, number one.
Yeah, you seem like a helper, a doer, a fixer.
And it was like a puzzle, and I needed to solve it. So I started doing a lot of digging around, and I came across the Divorce Lending Association, which specializes in divorce lending, and I became a certified divorce lending professional. And through that certification and what I learned about how divorce changes underwriting guidelines, I'm able to help people going through a divorce make sure that they can qualify for a mortgage once it's all said and done.
Okay. So you're there for them at that time. But now, if somebody is, and again, you hope that no one ever gets divorced, but it's not reality.
Right.
So people, somebody's starting to think about they're gonna separate and get divorced. Mm-hmm. When is that time? Because it sounds like when they come to you after the fact, it's a little too late. So when is that time that that they should be looping you in?
As soon as possible. If they're getting divorced and there is real estate involved, that's when I can be the most help.
Yep.
Right. People who are getting divorced are going through such an ordeal. It's such a hard process. It just, it's horrible. And the two biggest concerns that I see people have is, one, what's going to happen with the kids, and where am I going to live?
Sure.
And how am I going to afford it?
Yeah.
So if I can help bring clarity and peace of mind to that large piece of the process and help ensure that once the divorce is finalized, they can qualify for mortgage financing, then I think I've made a difference.
Sure. Are you educating them along the way so
Absolutely.
that they know like what paperwork they need, what if they're going to do a second job, like how long they need to be there before they're going to be able to qualify? Like, because again, it's a time of craziness.
It is.
Like they probably need someone in their corner a little bit.
I'm totally in their corner from start to finish, and I work with them as well as the divorce team to help make sure that the way the settlement agreement is structured, and even down to the language of the settlement agreement, to make sure that's not going to conflict with mortgage guidelines, that everything's going to align with underwriting guidelines. Because, for example, support income, depending on what it's called, can or might not be eligible income. So by working with each situation is different. So looking at their unique situation and working with the divorce team, it's going to help give a more favorable outcome to one or both parties. Because if you're doing an equity buyout, the ex-spouse wants the money. They need that money probably for their purchase.
For their next.
And to structure the settlement in a way that's going to work for both parties and ensure successful execution of the settlement agreement is an important piece of the puzzle.
So now when you look at your non-divorce business versus your divorce business, kind of which side of the house do you like better? Is there something that gives you more joy to helping with? I mean,
that's a good question. I like all parts. Like, I love working with first-time home buyers. Helping someone buy their first home is so satisfying and so exciting.
I remember 20-something years ago.
It's an accomplishment. It's a huge accomplishment, especially with the prices of homes these days.
Oh, totally. And there's different programs to help these first-time buyers.
So it's all puzzles, like figuring out what's going to work best for each person and having those solutions. But I do have a soft spot for divorcing homeowners, just because they're going through so much. And then to be able to see them move forward and have their new home or keep the marital home and provide that security for their family, that's really special too.
Totally, I could appreciate that. So doing this for 30 years, I mean, again, so what do you like? You've stayed in the same business for 30 years.
Well, there was a little time around 2008.
Yeah, all right.
But for the most part, I ended up back here.
So being in the same career for 30 years is not something everybody does in this day and age. People, some people can't stay at a job for more than 18 months.
True. 2008, when the industry blew up and I got laid off, I was fortunate. I got to stay home with my daughter, who was real little at the time,
Very
and
nice.
I got to be a stay-at-home mom for a little while. And I did try other things when I had to go back to work, but it's like you can take the girl out of the mortgage industry, you can't take the mortgage
out of the girl. So this is just what you know,
it's what I know, it's what I
like.
do, it's what I'm good at, and I love how I can help people, whether it's buying a new home or refinancing and saving a lot of money on their monthly bills, consolidating debt, whatever, or helping someone who's been through it with a divorce move forward and start their next chapter.
Yeah, again, all those things are like, and the home is most people's largest purchase. So, being able to help and get them in the right plan in an industry that is a little bit of the Wild Wild West.
Not so much now. Before 2008, yes.
Yeah.
It's much more regulated now, but there's a lot of options. There's a lot, and it's a lot, people don't do this every day, so.
Yeah, you do it maybe once or twice in your lifetime.
Once or twice, yeah. So to be able to educate and walk people through the process and help them understand it, being able to have a successful closing is kind of the byproduct of the education in my mind. I like educating people about.
Now, with all the people that are in the industry, how do you set yourself apart?
Well,
on the divorce side, it's easy. There's not a lot of you. But on the non-divorce side, how do you set yourself apart from ABC company and this guy, or a local bank or a credit union?
Well, I'm with the credit union. I'm with United Teletech
Okay.
Financial Credit Union, and credit unions are the best kept secret in the banking industry.
Tell people why they're the best kept secret.
Credit unions, we're a not-for-profit organization. So as a member of the credit union, you become an owner of the credit union. And all of we're not working for shareholders or stocks or anything like that. We're working for our members. And so much of our profits go back into better programs, updated technology, better interest rates. As a credit union, we've got access to very, very competitive interest rates, and we're not nickel and diming people. It's not about the fees. It's about that relationship, and to be a one-stop shop for people.
So why don't more people use the credit unions?
That's a really good question. I don't know. Like I said, it's the best kept secret.
I know, but that's a secret you want to.
I do.
Everybody
yes,
know.
everybody join the
Everybody
credit
should
union.
know. So now, what is it open? Is it open membership? Like I was in a credit union when I lived in New York 25 years ago. When I first got out of college, I was involved with a credit union because the company I worked for was next door, and they said,
Right.
"Oh, we're going to do the direct deposits.
Right.
If you sign up for this company, you get all these benefits." And they were great. It was the Bethpage Federal Credit Union. I don't even know if it's
I've
still
heard of them. Yeah.
a credit union, and they were awesome, and it was right next to my work, and it was great. But then I moved to New Jersey, and I wasn't involved with credit. So what gets people? How do people become members
So
of credit
United Teletech Financial started out as a credit union for about Bell Labs, Teletech, right? We went public a little over 50 years ago. And we're basically open. Anyone who lives in New Jersey, New York, Pennsylvania, or Delaware can join the credit union. And once you're a member, you can always be a member. Even if you move to California, you can still be a member. And if you're a member and you have a brother in Chicago, he can become a member because you
Because
are.
of me.
Yeah. And
That's pretty cool.
Yeah, it is. It's really cool. It's kind of like a financial collaborative. So the more you do with the credit union, the stronger we become, and the more we can give back to our members.
That's really cool.
It is. It's really cool. I love working at the credit union.
Anybody that's on Grit that was watching Grit Won't Quit and is looking for a mortgage, reach out to Stacey and join the credit union because then you get all these benefits and perks. We should do something with Wingman. All the members, all the employees become members.
We can definitely do that. We do that with companies.
Chelsea, I hope that you're listening to this one because Andrew will tag you and let you know. But I think we should look at this for Wingman employees, especially as many of them are buying homes in the next couple of years.
I will have Diana, my business development person, reach out to you for sure.
Cool. That's great. I think that's really cool, and I think it could be beneficial for both of us.
Oh, absolutely.
Cool. That was easy. All right. Thumbs up to that. Diana would look forward to speaking to you. I did not know all the benefits of the credit union. Again, like I said, I know about it 25 years ago, and I haven't heard about it since, and I didn't even know how to.
We do everything: checking, savings, online banking, investments, mortgages, home equity loans. Our auto loans are really good.
Really?
We're really strong with our auto loans. If you need an auto loan.
Do you do commercial auto?
I don't think so.
Okay.
I don't know. I'd have to ask one of my.
Only-
I only do the mortgages. So
We have Shubu, and we're always looking for more loans on vehicles. So if you have commercial,
we do
lending-
business accounts. We do commercial lending.
Okay.
So
Good to know.
full service.
I'm glad that you came in today.
Me too.
Even though we're in a networking group, I did not know all that information.
But we haven't
about
sat
the
down and done our one-on-one yet.
Well, we're getting it
Which
done.
we're doing it now.
Doing it live
with everybody
too.
else.
Yeah, we're doing it for the whole Grit Won't Quit community. That's awesome. I love it. I think that there's a lot of benefits and synergies with Wingman for that one. So, so now you're at the credit union. You could do all these great things that we just talked about. So, what's the best if someone is looking for a mortgage? What's the best way to start the process? Before they start searching for the home.
So if someone's looking to buy a house,
Let's go with the non-divorcee right now.
Okay. If someone's looking to buy a house, get pre-approved.
Okay. Through you.
Through me, of course.
So that you'll go through their W-2s and this and that, get them an approval letter so that when they start searching with their broker or agent,
and
they'll have a piece of paper in hand.
Yep. So we talk, and I always talk about what's your monthly budget, right?
Okay.
Because what I could qualify you for is probably going to be more than what you want to pay.
Okay.
Especially since interest rates, although they're a little lower now than they've been, they're still higher than they were.
Sure.
And housing prices are astronomical.
Especially if you're in Monmouth County.
Yeah. So I take people step by step, starting with, how much are you looking to pay monthly for your mortgage? How much do you have for down payment? What's your credit look like? We pull credit, we run numbers. This is the rate you would qualify for. Is this comfortable? Yes or no? And I can do a verified pre-approval if they provide their income and their assets, and that's going to make you a stronger buyer when you're out there, because sellers are going to want to see someone who's had their income and their assets and their credit all reviewed.
Yep, and you're verified.
Right. And then I customize the letter. You get an initial letter, and then when you're ready to make an offer, we update the letter specific for that offer. I update it as many times as you need to. And I always come back to here's your monthly payment. Are you good with that?
Now, just for the first-time buyer, because we have a younger audience here, is there a percentage? So, if your salary is was $100,000, let's just say.
Mm-hmm.
Is there a percentage or a baseline or a benchmark of where they shouldn't really be going over, because it starts getting into territory where you don't want to be?
So where someone's comfortable with and what you'll get approved for can be two very different things. What underwriters do is they say a certain percentage of your gross monthly income can go towards your housing expense plus your monthly debt. Housing expense is principal, interest, taxes, insurance, as well as if you have less than 20% down, you have private mortgage insurance, and if you buy a condo or townhouse, you have HOA fees. So that, plus monthly debt, which is minimum payments on credit cards and monthly payments on installment loans like car loans, student loans, that kind of thing. That the total of all of that has to be, depending on the loan program, 50 or 55% of the gross income. Now, not everybody's going to want to spend 50% of their income
On those two categories.
Right. So that's why I have the conversation, like, what are you comfortable with?
Yeah.
And very often someone will be, you know, for example, they'll say, oh, well, I want to spend $3,500 a month. Okay, great. Let's say they're well qualified for that. They go out and start looking, and they're looking at $700,000-$800,000 homes with taxes that are $12,000 a year or more, because that's typical for New Jersey. Sure. We come back and their payment is higher. So then there's got to be a little bit of give and take. And you know, if you find the house that you love and you're willing to go there, and you qualify, then that's fine. But it's a process, especially for first-time home buyers.
Sure.
You know, and if you've got, depending on how much money they've got to put down or what kind of generous family members they have to give gift, you know, we structure it in the best possible way to get the best possible outcome.
That's great. I love it. So the hard part is for a first-timer, like,
it's so hard.
I remember when I was a first-timer, and thankfully I've invested in real estate for years, and it's easier now. But I got it. The first timer, you got to just take that jump in.
Yeah. Well, the good thing is that real estate's always going to appreciate. Mm-hmm. So there's no point in waiting for prices to come down. They're not going to. And mortgage rates are starting to come down. Mm-hmm. I don't know how low they're going to go. But the saying is, you marry the house and you date the rate. Mm-hmm. Right? And you refinance when rates come down. But it's kind of like having kids. You can't wait until you're ready, right? You can't
just get started, jump in.
Just get started and jump in.
But I think that's important. And again, I was talking to one of Wingman's, a team member on Wingman yesterday, a younger employee, and she told me, I want to be out of my house, but by a certain time, 2 years. And I said, are you planning on buying or are you planning on renting? And she said, well, I really would love to buy, but I really want to also make sure that I hit my goal of getting out of it. But in my mind, and again, I don't know the situation at home, but I would almost stay one more year to bank the extra money to get out and buy the house versus, because once you rent, I feel like it's hard to start saving for. And
sometimes rent can cost more than buying. It's crazy.
Exactly. And that's crazy because the landlords, are just, charge whatever. Yeah. And I mean, I do think hopefully without these big hedge funds and private equity buying single family houses, that should help a little bit.
Hope so.
We shall see, but
yes.
I mean, more to come on that. But I mean, that conceptually makes sense to me. Mm-hmm. It's just now it's got to happen, and
right.
We'll see what happens. So, it's exciting though for a young person to buy a home.
It's very exciting.
They're out on their own. It's theirs.
It's just it's a lot harder now than when I did it the first time, for sure.
When I did it the first time, I bought a place in Long Island. I was 20 years old. Me and my brother bought a rental property, in the Hamptons, like almost like what these kids do, when they come down to Manasquan and Belmar, and they it was like one of those houses college kids rent, and we were renting it. We were renting houses in the Hamptons, and we were like, we should buy a house, and we put down. We got a very small inheritance from our grandparents, and we got $10,000 each, and we said, rather than take this and go buy a car, let's buy a house. And that was my first foray into real estate, and we rented the house out the next week. We bought it right around Thanksgiving, and by January 1st, we had a winter tenant in there, some college kids, and we got them out May 15th, and we turned it into
To a summer rental.
to a summer rental. We did it for like
Nice.
3 or 4 years. We made money, and we sold it, and we both bought our own homes
From the proceeds.
from the proceeds.
Oh, that's
so
amazing.
that's how we got our down payment.
That's amazing.
And then from there, then we just rolled it from there. But like again, to get in, we got in on a little bit of a technicality, right? But we were young kids. We're 20 years old, and we got a mortgage. Like that was crazy. That in itself was crazy.
That was the Wild West, huh?
That was the I was a college kid. I came home for Thanksgiving break, and that's when we did the closing the day before Thanksgiving.
Wow.
Because I said I can't come home from college. My brother was a little bit older, and he was in the workforce. So he had a salary. I was a bartender, so I didn't really have a salary. Now we're landowners in East Quogue, New York. But it was there was some wild stories from that.
Oh, I'm sure.
Think about renting a house 25 years ago. It's crazy, but it all worked out. And but that got me into real estate. And then from there, we both took our proceeds and bought homes for our family. So it worked out, and it was cool. And it was fun. It was a fun time during doing it.
Yeah, I mean, if you get in, and the great thing is that there's a lot in the industry to help first-time home buyers.
Yeah.
The rates are lower for a first-time home buyer
cool.
than someone who's not a first-time home buyer, and the minimum down payment's only 3%.
That's
so
great.
Some people think you have to wait until you have 20% in order to buy a house. No, you don't.
Now, do they have to pay the 3% though? Then
There's
they have
private,
to pay
the private
PMI.
mortgage insurance. Yeah.
But now, after they do that for a little, and the house appraises higher, they can get out of the PMI, right?
Yeah, well, different loan programs have different requirements.
Yep.
Like conventional, as soon as you have a 20% equity, you can request an appraisal to be done, and that could be either through paying the loan down, doing improvements to the house, or natural appreciation. FHA, you can't really get rid of it for a minimum of 11 years,
Oh, wow.
so that's a little different.
Yeah.
And if you only put the minimum down, you can't get rid of it at all, but you can refinance out of it.
Yep.
So
there's options.
There's always options.
And again,
but it's,
once they're with you, then they can just keep, like, they can find, if they need a new program or they're ready to opt out, they can just come back and have you.
I was thrilled. I got a call the other day from clients that I helped them buy their first house 2.5 years ago.
Oh, wow.
And they came back, they're like, hey, they're selling the house they bought for $500, they're selling it for $700, and they're looking to buy something for $850. And
Winner, chicken dinner.
And I was so thrilled that they came back to me, and I'm so happy to be able to help them again grow, their family into a new house. So it's very exciting.
That's a win-win.
It is.
Everybody's happy.
It is.
And then now they have some equity so that it's a little less stressful.
And they can make a larger down payment because they've got they're getting a lot of from the proceeds of that sale to use for their down payment.
And I think that's why first-time buyers have to jump in, because again, you look at this case, there's $200,000 of appreciation. That now they can go again. They buy that $800 or $850. They're right around the 20% mark at that point.
Yeah, and they are putting 20% down, and their payment isn't
that much different.
because they didn't put 20% down the first time.
Yep. That's great. I love these stories. And again, that's like them starting to start their families and start to get roots in a community. That's awesome.
Yeah.
So this was a great episode. It was very inspiring. And Wingman's gonna have a takeaway here.
Yeah.
So as we wrap up today, it was great to have you on. Let people know where they can find you. If it's your website, on social medias, whatever is the best way to contact you.
Okay, so the best way to contact me for a traditional mortgage would be through United Teletech at utfinancial.org. If you've got questions about divorce mortgage planning, my website is divorcemortgagesolutions.biz. And I'm on LinkedIn.
Okay, great.
And Facebook, and everywhere.
All right. Awesome. Well, this was a great conversation. Thanks for coming in today.
Thanks for having me.
Thanks for educating us all. And
My pleasure.
I'll see you soon.
Yes, thank you.